Good afternoon, traders. This is Christian from Tropic Trade Group, and this is your end of day market recap for Tuesday, the 11th. Well, was today a turnaround Tuesday? I don't know. You had the Dow down 1.1% today, the Q's down 0.2 of a percentage point, a little bit of a sell off there at the end of the day. SPY finished down 0.8 of a percentage point. Right? It almost felt like we had a green day on our hands, and maybe that's because some momentum names were, popped a little bit today. Maybe an oversold rally today, but really not a turnaround Tuesday today. We didn't get it. And here's what I mean: like microcaps were up today, so some of those smaller cap growth names did bounce today. Like for example, like if you look at today's outperformers, it looked like Reddit was up 14. Again, really like kind of crazy numbers. Reddit up 14%, SMCI up 10%, BE, CRDO, MSTR, MDB, which got annihilated to the downside. AppLovin was up 8%. But again, if you look at some of these charts, you think, oh, great, what a big day for these names. But the trend is down for these names. Yes, App found some support here, but it's still below the 5-day moving average. So this is just a bounce and a downtrend right now, or a bounce after the sell-off that this stock has had. Still, big moves for some of these stocks, but really didn't do much. Before I get into any more of the nitty gritty, risk disclaimer in front of you, everything that we're going through is for information purposes only, not giving any advice or recommendations. Please read the full risk disclaimer there. So a little bit for me, like an unimpressive move today, considering that the S&P was down 0.8 of a percentage point. That does break the streak, I guess you could say, of S&P moves. We had 6 in a row of plus or minus 1% days. Then that broke that on Friday. Then we had this down 2.6%. Sorry if you can't see this. Let me zoom in a little bit. 0.8 down today at, following a 2.7% move down today. So I don't know, like, like I said, there is a decent amount of growth names up today, which kind of helped a bit, but overall for the market down 2.7%. Also, what I noticed, I was talking about how RSP held up, which is the equally weighted S&P yesterday till about lunchtime. Today, RSP was down 1.3%, which is what the average stock did in the S&P, because that's the equally weighted. So yeah, for me, like I think a little bit unimpressive. Even though we bounce from the lows, I guess that is something. So let me talk a little bit. I'll talk about what outperformed. Bitcoin, made a nice move today, but again, I don't know if we did anything special here. Other than bouncing, we're still way below all these moving averages. So again, basically what I see is just bounces that occurred, after some decent moves to the downside. There's Bitcoin. I like what gold did today, although didn't really do much. I tried some AEM today, which again, it's just very difficult to swing trade in this environment. I take for example, this is what's happening on a day-to-day basis is no follow through and a big whip to the downside. Look at McDonald's, for example, right? Look like a nice clean breakout that happened on Friday. Try to go higher on Monday and failed, and then look at it down 3.3%. So all I'm illustrating here is how difficult this environment is, and even with your lower volatility type names, we're just not really getting any consistency on a day-to-day basis, especially for some of those things that are showing some relative strength. They completely kind of tumble the next day. And so that just makes it a difficult environment, and I think an environment that you kind of want to be patient in for now. What underperformed? So I mentioned precious metals did well, metals and mining, uranium stocks. There's talk about what's going on with Canada, which I don't really want to get majorly into. Software stocks bounced today. They were up 1%. I mentioned crypto stocks up 2%. But look at the things that were down today. Home builders, which again, we're showing some life the last couple of days, down 2.2%. Transports were down 3%. Industrials were down 1.5%. Energy stocks back down. Healthcare stocks back down. A little bit of a defensive nature in there, but there is this crazy whipping around of different sectors on a day-to-day basis. So I want to talk about a couple things. SPY first. Let's go through the index charts. Again, there's nothing really to get excited about here. We're still moving down. We've moving down into the value area now for the year. We're stuck in this downward channel. We kind of rallied a little bit off the bottom of the channel, but there is nothing like, again, you could make a prediction, like anybody can make a prediction, and I see people do this. Oh, we're going higher tomorrow. Okay, that's great. I mean, I generally just like to do the analysis of what the technicals are telling me rather than making a prediction. Do I think that we're eventually going to see a bigger bounce here? I do. And I'm going to try to formulate that a little bit in this video for you rather than it's not a prediction. Let's just talk about things that we need to kind of see. Number one is like we need to see a move out of this channel, and yes, that will be a little bit late, if once we do start to move out of this channel, because that bottom of the value area for the week, which is close to the top of this channel, this trend line that I've got drawn, is about 2.5% up. So, I mean, we could rally quite a distance before we even know that the trend is changing here. So that's why I kind of stress patience. I think also it depends on your time frame, as always. Like this may, like, if you are adding incrementally to your 401k plan or your IRA and doing things, investing over time, you don't have to try to pick the very bottom here because you're dollar cost averaging and you're doing this over 10, 20, maybe even longer years where you're just getting lower prices, with the thought that in a year from now, or could be it could be a couple weeks, could be a couple months, it could be more likely that as you go further out, the probability increases that the market is higher because the market goes up over time, right? And that's something that we've known since the history of the stock market. It does go up over time. It also has corrections from time to time. So that's also something to be mindful of. So we're sitting here just inside value. Yes, I would like to see us get above 561.37. Qs fared a little bit better, but ultimately not doing anything special today. So we do have some big economics that come out tomorrow. I want to spend a minute or two here because I think that this is going to get very, fairly important, right, in terms of economic data. So tomorrow we have the CPI, 0.3 is what they're expecting, which means that inflation is still running hot if the number comes out in line with expectations, 0.3. What I would like to start for, where I think this market needs to go for it to get back into a sustained uptrend or just better overall price action, right, is we need to see inflation come down. And I'm going to explain that. PPI, they're also looking for 0.3. So like if this number comes in 0.1, 0.2, maybe that will help. Why is this more important than it was in going back to last year? All right, so I'm going to talk a little bit about monetary and fiscal policy. I've done this in these videos before, and again, I'll try to keep it brief because I don't want to keep repeating myself. But I think that if you go back to the great Marty Zweig, right, and this is like going back to like 1970 type stuff, right? He said, don't fight the Fed, right? Now, if you go back to the last couple years, basically when interest rates topped out, when the Fed was done raising interest rates, right? So like right in here, right? I'm looking at a long-term chart of the short-term interest rates. This is what the Fed controls. They don't control TLT. They don't control long-term interest rates. They control the overnight lending rate, right? So very, very short-term stuff, right? So we, gravitated up here 2020, 2022, and then we kind of topped out here in 2023, at a pretty high level, right? Over 5% is where we topped out at. Now, why didn't the market sell off when that happened, right? High interest rates, that's tightening. As Marty Zweig says, don't fight the Fed. Well, he also said, don't fight the trend because there could be other things that were going on. What was going on? Well, when we look at all of this and what the Fed does, that's called monetary policy, right? And there's somebody by the name of Keynes who has some theories about increasing, decreasing the money supply and what that does to the economy and so forth. But that's not the only policy. Monetary policy is not the only policy out there, right? The other one is fiscal policy. And that's whether or not, and usually traditionally, when you think about fiscal policy, it's whether the government is what they're doing with taxes, right? Like when I read, back in college and took economics macroeconomics 101, they talked about monetary policy and the money supply. and fiscal policy with basically like cutting interest rates is something that normally happens. Well, what did we see over the last 4 years? And again, I'm not trying to get political. I'm just trying to explain what transpired and why the market didn't go down, why equities did quite well, even though interest rates were so high. And the reason is because the Treasury was stimulating the economy. They were increasing the size of their balance sheet. They were increasing debt to, what we believe now is probably unsustainable levels, right? We went all the way up to $34 trillion and a huge amount over the last 4 years that they increased the overall debt levels, right? And that's inserting liquidity into the market. So what comes, so that's under Janet Yellen's tenure. And after she left, what essentially has happened? Well, the that debt has stopped going up. That they've turned those spigots off, right? In terms of inserting all this stimulus into the economy, which, by the way, was completely like what the Fed was trying to do with tightening, right? To bring down inflation. They completely like crossed that. They completely took those effects that the Fed was doing and they erased them, right? And they basically undid what the Fed was trying to do. Hence, that's why inflation has not gone down, right? Because if you're stimulating, right, you're completely undo the tightening that the Fed is doing. Okay, so fast forward to where we are now. Now we don't have any of that stimulus coming from the Treasury Department anymore, right? On the fiscal side. So we have tightening, which is going on right now. Hence, the market doesn't like it, right? So we don't have that backdoor stimulus, by the way, that nobody has been really talking about. You won't hear about that in the media, right? You won't hear about that anywhere, but that's basically what's been happening over the last 4 years, right? So we're at $36 trillion of debt. And now they're coming to grips with, hey, we've got to reduce this debt. Well, and let's talk about for a quick second. Why do we have to reduce the debt? Well, because right now, the biggest expense that we're dealing with, it's not healthcare in the country, it's not defense, it's now servicing all of that debt and the interest expense. And as higher interest rates go, the higher the bigger the interest expenses. So it's not now again, I don't want to get really too far into the weeds of this, but that's not sustainable. It's not sustainable to keep increasing the size of the overall debt level. And it would be one thing if all of the debt was held in the United States, but we know it's not. Japan, China, multiple other countries are holding our debt, right? So we're dependent on them to keep buying, right? How do we get ourselves out of this situation? We get ourselves out of this situation by stop the spending, right? So again, that's very controversial right now because of politics and so forth. But from going back to the market perspective, that's why the market's not doing so well. We don't have any more backdoor stimulus that's hitting the market. What would help right now, right? Well, what would help right now is if inflation goes down, right? Then if inflation can go down, then they could start to decrease interest rates, right? And start bringing them back to more of a normal level. Why do I have this chart up for you? Because you could see this is where, notice what happened in here, right? The last time that the rates were this high for this long, that was in 2007 to 2009. What happened then? Do anybody remember what happened in 2007 and 2009? We had a complete financial meltdown when that happened. So this has to come down, right? And inflation, like this has to start coming down, right? Now, I'm going to talk. So that's the negative stuff, right? We know for seasonality, we're here, somewhere in here, right? And we know that the end of March is supposed to be strong, right? This is S&P seasonality, right? Here's March, right? April's supposed to be strong. We're supposed to be starting to enter this stronger period. What do we have on the docket after after we get through CPI, PPI? Well, if you look to next week, you got this guy Powell speaks, right? We're going to get a Fed decision. Now, they're not expecting anything, right, uh let me bring this up again, right? There's basically no chance that they're going to cut interest rates come next week. However, look at what's happening here in May and June, right? The market is starting to imply there's about a 41% chance right now that they're going to cut interest rates. So that's something, right? Now, if Mr. Powell comes out and blinks and says, hey, we're starting to see some softness in certain areas of the market, right? As the market is starting to price in some softness, and that's why we're going down, right? It's because the market is probably pricing in some softness in the economy. Today we heard Delta came out and said, hey, we're not expecting that the consumer continues to spend as they normally do, right? So if Powell comes out and what's called blinks, right, and says, hey, we're going to start to, our plan is to start to cut interest rates again. What do you think is going to happen with the market, right? The market's probably going to embrace that. And the market is, and could really kind of make a turn and rally. So that's not a prediction. I'm just outlaying a particular scenario that I think could play out. First things first, if this number, so I mentioned if this number comes in lighter, it would be good. If this number comes in hot, 0.4 or zero point 0.5, right? Then odds are Mr. Powell is not going to say much next week. But maybe if he starts to see some progress that inflation is coming down, right? You might get that, right? Now I know you're probably going to say, well, Christian, I'm hearing about tariffs and tariffs are supposed to be inflationary. Well, not when you, not when it brings up uncertainty and people don't know what the hell to do and they stop their spending, right? You may, companies may need to make more of their products more expensive, but if nobody's buying those products, then what difference does it make? So that's the whole argument of like, okay, that the tariffs may or may not matter. We don't know. That's uncertainty, and uncertainties in the market. More uncertainty in the market. Remember that the stock market is a confidence game. The less confidence people have about the market tends to go down, right? So I will leave it there. So I've outlined a scenario for you where we could, because I didn't think today was all that impressive. But I think if the monetary, considering we don't have fiscal easing anymore of the past 4 years, we're going to need it to come from the monetary side, the monetary policy side, which means cutting interest rates. Stay tuned. The other reason why I bring this up and not like, oh, do this tomorrow, do that tomorrow. Think about, a couple steps ahead here, right? And what needs to happen in order for this market to kind of come back. And I think the tightening, which is now much more apparent than it was a couple months ago, that needs to chill out and rates need to start to come down again. That's it for today's video. Have a great night. And if you like this type of education that I insert in here, please like the video, subscribe to the YouTube and all that stuff. Have a great night, everybody. See you tomorrow.